My name is Brant Portugal. You guys, some met me earlier today. I graduated in 2002, biology major, Spanish minor. Currently work at Citibank. I'm a director in foreign exchange corporate sales. I'll talk a little bit later about what that actually means. But let me have Will and Jess introduce themselves.
Will McLeod. I graduated in 2008. I was a business administration major with concentration in finance and economics. I'm currently at Nomura in the global macro sales group, which basically trade currencies and emerging market rates.
Jessica Marino, class of 2004. I am at Nomura and as well with Will, and I am a VP in international equity sales trading.
Cool.
Yeah.
So we are the Sales and Trading Pod. We get to give this presentation 4 times today, and you get to hear it first. So hopefully it continues to improve throughout the day. But want to just give you guys an opportunity to understand what sales and trading is. I mean, people use that term so freely, and it's important to really understand the differences between salespeople, traders, how they work together, how they partner, but also really what the differences are. And then we'll go through some of the market-specific functions, foreign exchange versus equities versus fixed income versus credit, and talk about what the various areas are, because I think it's always interesting, you know, you're interviewing for a job in sales and trading, but what is your real interest? Some people really like macro, some people really like micro. Everyone knows what the equity market is, but do people really know what mortgages are and how they're traded? And then we'll kind of wrap up towards the end with some basic interview tips, allow you guys some opportunity to take questions. We're scheduled to run until 10:50, so we'll probably talk for about 35, 40 minutes and then give you the opportunity to ask some questions at the end. Encourage you all at any point to stop us and ask questions. So, again, this is our outline for today. What do sales and trading do? The market basics. What are the different roles and products within sales and trading? And then what's your role as an analyst when you start, and how do you progress? And then we'll finish up with the interview prerequisites and recommendations. And if we have time, we'll do our interactive market game. So, 2 roles, sales and trading. Take risk, manage relationship. These are all a list of things that are involved with our business day to day. Markets move, asset prices change. It's all about understanding the story behind it and then advising your clients or executing on that risk. So based on sales versus trading, where do you think take risk falls under? Sales or trading? Both? Did you say both? Sales, trading?
Trade.
Yeah, I mostly trading. Salespeople take risk, but not necessarily market risk. Salespeople generally don't hold positions overnight, although you may hold positions intraday before you clear it with the trader, depending on the product you're in. How about managing relationships?
Sales.
So sales, yeah, traditionally salespeople would be managing the relationship, but there are a number of instances where, you know, clients want to hear from the traders. So if in Jess's equities role, you know, bringing out traders or sales traders to a client event is a big deal. The clients really want the time because the traders tend to be on the pulse of the market. They're the ones taking the risk. They're the ones getting paid for the P&L that they generate in the same way that our clients get paid for often the P&L that they generate. So traders have relationships as well. Traders manage relationship with the salespeople, with the risk managers, and with their own sort of colleagues or own peers at other institutions that have traders as well. Daily P&L.
Trading.
So traders would most typically have a daily P&L, but salespeople have to be measured in some way too. So Will's account production with his macro community, he knows at the end of each day how well he did based on whatever the firm uses to monitor that, whether it's enterprise value is something you hear often, EV, sales credits, or hard markup. Those are three ways in which salespeople measure themselves in their ability to generate business from an account. So hard markup is if you buy something for one from your account and sell it to another account for two, right? That's sort of a concept of hard markup. That one unit of profit is a hard markup, P&L. Enterprise value or sales credits are a way in which the franchise managers demonstrate or reflect the value of that flow that's coming into the bank. So even if I buy it for one, or even if I sell my account something for one and a trader doesn't necessarily make a profit right away, there's some value ascribed to that flow. And it's different between the product that you sell, the tenor of the product that you sell, the type of product. So there are all different ways to ascribe value to that. So salespeople are measured with a P&L as well, but traders are really the ones that manage risk of that P&L, where salespeople just try and sort of grow the P&L rather than there's really not that many opportunities for salespeople to lose their P&L. Trade ideas.
Trading.
Trading? What do you think?
Both.
Yeah.
Totally. For equities, definitely.
So you're on the research sales side, right? You're on the sales trading side. Sales trading. So yeah, when your job is to be an idea generator, whether you're a trader or a salesperson, or it's just really important to be able to have a reason to call your account. You know, what's your idea for the day? And your view may be different than the trader's view. It may be different than the person in research who spends all sorts of time developing these in-depth analytics of various companies or various macro products or micro products. But your job as a salesperson is to have a view, generate ideas, pitch them to your account, understand what your account cares about, and be able to sell it in a way that makes sense to them. The traders are generally pitching ideas that are consistent with their book and consistent with the way they view the world and the risk that they have on, whereas the salespeople are pitching ideas based on, you know, their personal view of the market and a way in which it resonates with the account. So
I think that's just, if I might, it's an
Yeah.
important distinction in terms of I think both sales and trading would be involved in trade idea generation, but the difference is that the trading desk they have their own agenda. They sort of have an outside opinion. They have a relationship with the account, but it's a much more distant relationship, and so it's a more independent thought of looking at the whole market, and these are the ideas that I really like depending on the market. Whereas the salesperson is the touch point to the account, and so they may take that trading idea. I might take that trading idea and use it if I know, but the salesperson is the one that talks to the accounts on a very, very, very regular basis, and so you have to know what they like or don't like or whatnot, and so you might use a trading idea, but you might also have to tweak it a little bit and create your own in order to fit the accounts, because that's sort of where the role of the salesperson comes more to the forefront, I think. So just
yeah, no, I think that's definitely worth mentioning. Is you have to know your account to know how to spin the story in a way. I mean, it could be the same result, short company XYZ, but the reason you spin it to account one is because it's an industry focus, an industry play, and they tend to look at things, you know, top down. Whereas to account two, you may spin it as, well, look at the fundamentals of this company, and this is the reason why you want to short it, from a sort of bottoms up analysis. So very important. Liaison between client and market maker. I don't know what that means, but so let's skip that one. Sales. Let's call that one sales. Maintains risk overnight. Specific expertise in a particular asset class, really considered the specialist.
Trading.
And a generalist responsible for coverage of multiple products.
Sales.
Good.
those are two important, just in terms of you guys putting in your head. I think the bottom two are really pretty key in trying to like differentiate what is sales versus trading. I think those are two sort of trading. You trade a product and you're very knowledgeable in that product and you know it, in all dimensions. versus sales, depending again on your clients. You may have to talk to this trader and that trader and that trader, and each trader is specialist in their own way, but you need to be able to cover a number of different fronts. So that's just in terms of in your head. It's kind of helpful to think of it in that way, I think.
Yeah. So, for instance, for what Will and I do, or even what Jess does, we have traders that trade specifically euro dollar. Right. That's what they do all day. Buy, sell euros all day, and then you have in Jess's world people that trade just technology stocks all day. And but we need to be able to talk to our accounts not just about technology or not just about euro. You need to be able to talk about the market in general and the various currencies. And so, whereas the other traders may know about what's going on in the other sectors or the other currencies, their job is to be the best at that particular currency or those particular groups of stocks. And as you're thinking about today, Elizabeth Cummings, for those who were on the part of the morning session, she was a recruiter from Citi who talked about 3 whys. Why do you want to do sales and trading? Why do you want to be at a specific firm? And why should you be chosen for that specific job? And as you're thinking about the why sales and trading, you really should start thinking about, honestly, whether you really are the type of person that digs really, really deep into one thing or likes talking about a multitude of different things and developing a story, and that'll help you over time understand the differences between sales and trading. Or a difference. I think this is a good slide because I think it illustrates, what we do on a day-to-day basis. We have, client ABC calls one of us and wants to do a transaction. They want to buy Microsoft, let's just say. Actually, I'll walk through it in the foreign exchange standpoint, and then we'll do a little bit different, which is equities. So in FX, a client, let's just say a U.S. corporation, wants to hedge a cash flow exposure. Let's say they want to hedge earnings. So a U.S. corporation makes money in euros abroad, and going forward, the value of that euro revenue or that euro earnings can change based on the exchange rate of euros to dollars, right? So if the euro strengthens against the dollar, the value of those earnings increase. If the euro weakens, the value of those earnings decrease. So clients will often want to hedge that risk going forward to the extent that they can, depending on the currency. So let's just say they're looking on a 1-year time horizon, and they want to sell euros forward because they think the euro is going lower. So they would enter into a forward contract to hedge their euros by selling euros versus dollars at a predetermined date in the future at a predetermined exchange rate now. Okay? So they call me and say, Brant, I need to sell 100 million euros for October 1st, 2012. Okay? So I understand what they're doing, translate it into trader speak, and I say, call my trader on the spot desk who trades T+2, and I say, I need your left-hand side or your bid, euro dollar, on 100 million euros. He gives me a price. Then I call my forward trader, and I say, I need your left-hand side in the 1 year for 100 million euros. And then I give the client the spot rate, the forward rate, add the two together to get your actual outright predetermined contract rate for the future. And client says done, I tell my spot trader he's done, and I tell my forward trader he's done, and then we have an agreement verbally. So the customer calls me, I give the client the rate, and I clear my risk through the trader. The trader can hold that position in euros because the client has sold him euros. So he can hold that position in euro dollar if he thinks it's going up, or he can decide to sell it into the market. Okay, so the key difference is I'm an intermediary. I generally don't take risk, and I give the risk position to the trader, and then the confirmation is done. In equities, there's a bit of an intermediary step in that. We'll get into that in equities, just the difference between research sales and sales trading. Okay. So, how does the trader know what price to make? That's one of the key determinants in a relationship. All clients want sharp, good pricing. There are a lot of factors that affect the way a trader will price risk, who the client is, etc., and what positions they have. So let's just talk about, what do you guys think some of the factors are that go into market making, or what influences the market price that a trader provides? Volatility. What else?
Supply and demand.
Supply and demand, yeah.
Risk of the current positions.
Yeah, so his current positions. Volume, yeah, the size of the transaction.
Inventory.
Yeah, so supply, yep.
Future expectations.
Yep, what his view is. Yeah.
Political stability.
Yeah, absolutely. So if he thinks he takes risk on, and all of a sudden there's G20 comments that come out that can influence it. So geopolitical events or general politics certainly. What else? All right. So there are a number of factors that affect markets. Economic releases. If you ask for a price at 8:28 before non-farm payrolls come out at 8:30, your price is going to be a lot different than maybe 8:31 because liquidity dries up right before the economic release comes out. Traders generally don't want to hold risk into a big important economic release like non-farm payrolls, and you might get the sense that maybe the client knows something you don't. So a lot of traders don't like when clients come in at 8:28 for non-farm payrolls and ask for a price in something. Political events. If Obama's going to deliver a budget speech that night, you can bet that's going to affect pricing. There's obviously a lot of behavioral psychology involved with the market in terms of how do you feel about risk sentiment overall? How are all of the influences coming to the market together and resonating with the trading community? Do they feel like it's a good time to be taking risk or a bad time to be taking risk? And a lot of people clear out risk going into the weekend because they don't know what's going to happen over the weekend. So that influences the way traders make prices and affects the market. Interventions, we just had one of the most historical events of foreign exchange market happened a number of weeks ago, where the SNB, the Swedish National Bank, went in and pegged euro against Swiss. Sorry, I said Sweden. Swiss. And you had a 7% move in currencies in one day for Euro Swiss, and that was a big deal because Swiss had started to get too strong, and the Swiss National Bank didn't like that for a number of different reasons, and so they moved a peg on the Euro Swiss. So the central bank has said they will stand behind that rate and defend it, and that's an example of intervention. You have future expectations, which we talked about. Positioning of the trader. If he's long a bunch of euros and doesn't want to get long more, he's probably going to show you a lower price. And then you have technicals that influence the market. What are the moving averages? What are key resistance levels, key support? And those are very important influences because all these trades that get done generate market data. It's a print on a blotter, and as you start to shape the way that blotter looks and understand over time how those patterns develop, you start to see that there are influences, and there's a lot of academic stuff behind that. So we're going to talk about some various products today, and the sales and trading and structuring roles within each. FX, commodities, rates, securitized products, equities, credit, fixed income, munis, prime services, and just structuring in general. So, foreign exchange, this is where Will and I work at different firms, but FX is the largest, most liquid market. Everyone thinks, well, how's the market doing? Everyone responds, well, equities are up. But really, foreign exchange is the largest, most liquid, most active, and also most inefficient market altogether. Because if you think about foreign exchange, which is different from equities, which is different from credit, is that people need to be in the FX market every single day, whether or not they like the price. I'm going to Europe tonight. I need to buy euros. I would like to have bought euros 2 weeks ago, but I need to buy them because I need to go. Corporates need to pay their expenses in yen. whether they have, every week they have to meet their salary obligations, whether they like the level of yen or not. So U.S. corporates have foreign expenses. That creates somewhat of an inefficient market because it doesn't always mean that the price that exists is truly the clearing market. Well, it means it's a clearing market price, but it doesn't necessarily mean it's the right price for that security. It just means that there's supply and demand that exchanges at that level. Whereas equities, tends to be more reflective of the value of the perceived value of a company, because only people participating in the market are people that buy it because they think it's going higher or sell it because they think it's going lower, right? You can't do anything else with equities. That's just the bottom line. So in most of these products, sales is generally organized around the client base, I would say, and you have corporates who participate in the FX market, you have banks who participate in the FX market, and then the institutions, which are the international equity fund managers as well as the hedge funds. And then you have product-specific people that deal in the trading areas, which is spot and STIRT, which stands for short-term interest rate trading, which is really the forwards market, options, and then what we define as local markets, which are sort of the restricted currencies, the Brazils, the Chinas of the world. So hedge funds and institutions are in the market to take views, make money from the trades. Corporates are in the market to cover their risk for the most part. They're not generally trying to generate P&L. They like to do their business well and mitigate the risk of their currency, and that's their hedge program, their risk management program. In FX, technicals are a huge factor every single day affecting the market. We're always talking about the moving averages of various currencies and different patterns there as well. Spot, again, is the exchange of two currencies for T+2 time. If you need to buy currency or sell currency to give it to someone else, that's a spot trade. If you want to do a hedge, because you're an international equity manager who's got exposure to European sovereigns, but you don't want the euro risk, you can strip out the euro risk by doing a forward hedge in FX, and then you just have the underlying credit or equity exposure, and that would go through the STIRT desk. And then you have options, and in FX options, you can do everything that you would think you would do for an equity option. You can do for foreign exchange. You can do things as basic as buy a call or buy a put on a currency, or you can be complicated in structured basket options or structured notes that generally reflect the underlying portfolio of a bunch of different moving parts. You have anything else to add on FX? That's good.
Yeah.
All right. Commodities. So these are the various areas in which commodities we make prices in, or most banks would make prices in, and commodities is a real tangible thing. I mean, it's, you're and often, I mean, you can trade in futures and that sort of thing, but there are deliverable markets for energy, deliverable markets for base metals, and it's one of the most volatile products to trade in. I mean, the vol of natural gas can be it's like 60% or something, whereas the vol for Eurodollar in 1 month is 14%. So it's an illiquid market. It's volatile. It's controlled by a few major. I shouldn't say it's controlled. There are few market participants who tend to be the best and the biggest in commodities. But again, you have corporates like airlines that need to hedge their fuel exposure, and you have building, like large industrial building producers that want to hedge the cost of copper, and then you have institutions who are on the other side of the trade trying to make money from their directional views in commodities. I always thought it was interesting to know that there are weather derivatives. I didn't know that when I was sitting in your seat. So it's not a large or active liquid market, but they do exist. So if your business is weather dependent.
Like a farmer.
Like a farmer, exactly.
True.
So rates. So again, so far we've talked about macro products, FX, which is currencies, commodities, and now rates, which is a large liquid market. So interest rate products, treasuries, agencies, pass through, all of the governments, whether it's US government, the UK, everyone has the various bonds because they need to fund themselves. And these are the funding mechanisms, and as you probably read about in the Wall Street Journal, the creditworthiness of a lot of governments has been called into question. And what is the value of a AAA? Is the US a AAA entity? And that was one of the big recent current events is the US getting downgraded. There tends to be a rates trading group. They trade in the various fixed income derivatives, government products, and sovereign securities. You have basic government bonds, government notes, but then you also have options and swaps that are involved in the market as well. Risk treasury, every bank has a desk that does this in the finance desk. It's not necessarily an active desk in marketing to clients, but what it's trying to do is fund the bank. So we, as a bank, will pay out different amounts of money for what we call repo transactions, where we either take in collateral and pay a client an interest rate, or we borrow collateral and pay an interest rate, or we get paid an interest rate and give out collateral. So depending on the firm's funding needs, if we need cash, we're willing to pay more for cash, and if we don't need cash, we pay less, right? And so the repo market and the funding market would come through a risk treasury area, and the risk treasury desk also funds all the traders. So if a Eurodollar trader has on a position overnight, he gets charged a cost of funding based on the bank's cost of capital to carry that position. So when traders are thinking about positions, they have a true cost that's charged them every single day for borrowing funds from Treasury in order to take on that position. Whether you're in equities, whether you're in foreign exchange, mortgages, everyone gets charged to do this. Let's see, what else? And when you think about rates and money market products, I mean, money markets in 2008 were really the first sign, or I guess it was 2007, the first sign of cracks in the financial crisis, because all of a sudden the money markets started to dry up. And the money market should be very, very liquid, where banks lend money to each other and borrow from the Fed, and everything works in a nice little circle. But when banks stopped lending and borrowing from each other because they were concerned about counterparty risk, money market rates started to spike. And it was the first sign that liquidity was drying up, and then, quote, a crisis of liquidity became a crisis of confidence, which became a crisis of solvency for all the banking institutions. So money markets are looked upon, which is again like the short-term trading of funds, looked upon very frequently for indications of the health of the overall banking institution. Global securitized markets, this is not an area of my expertise by any means, but anything that can be bought, packaged, and sold in different forms is securitized. Securitization is, I buy all of your GPAs, and I take a view that the average GPA is going to end up being a 3.3 or 3.0, and if it's above it, I make money. If it's below it, I lose money. But I bought my right to own all of you and your GPAs, and someone takes the opposite side of that trade. When you're buying a portfolio of mortgages, you're betting that between Jess, Will, and I, the houses that we buy, it's going to be a better credit if we're all similarly rated and we all go into the same pool, that it's going to perform better than just buying me alone and taking my individual risk. So what happened is, all of a sudden during subprime days, the creditworthiness of borrowers started to become lower and lower, and no doc loans, no document of income, no verification of employment. It was just all on word of mouth. And so you started to create a market in which the underlying assets may not have been as good as they were documented to be. But there hadn't been a market for those people to borrow money in the same way that they had been able to during sort of the boom days of 05, or 04 through 07. And all of a sudden, the subprime borrowers had access to markets because all the banks were trying to originate these loans, package them together, saying, well, 10 lower or substandard credits put together is a lot better. A lot better than one individual substandard credit, and there was a big active market for it, and there was a lot of leverage behind it. So again, structured products, whether it's mortgages, you have structured credit, where you take a bunch of credit default swaps, you put them together. Again, concept being the portfolio effect of bringing products together. Anything down on
Yeah, it's just that's fine. Yeah.
Yeah.
It's more complex. And just,
Do you want to talk about the equity space?
Sure. Right. So, so in equities, okay. So there's three different roles sort of within equity. So I'm in sales trading. There's trading. We talked sort of about trading and sales. There's one more role in equities, and it's research sales. Then there's sales trading, and then there's trading. And the difference is that in equities, clients like to have research, right? What is our view on Microsoft? And so we have people much smarter than I that do all of their work on Microsoft or any of the software companies, a number of software companies, and they print research reports of what they found, what they think of the company, right? Based on fundamentals, all of that, right? Buy, sell, whatever, an opinion and a price target in their model where they think, it should trade on a multiple, whatever, all these things, right? You've seen this. And then as the research salesperson, you take that research and you go out to clients and you say, this is what we think. We think that Microsoft is a buy. Everybody else on the street thinks that it's a sell, but we think it's a buy, and this is why. This is what our research, this is what our analyst says, this is the report, et cetera, right? So they're pushing product, actual paper product research. Then as the sales trader, you then touch the account. You're talking to the same account, but maybe a different person within that account, and you're talking to them about the actual point of transaction. So the sales trader and the trader are talking to the account for actual point of transaction. So Brant is my research sales guy, and he's talking to the client about Microsoft. We think it's a buy. This is why you should buy it. This is what our analyst says. I then call the trader at the account. These two work together, right? And I call the trader, and I'm like, okay, what do you think of our call? We think you should buy Microsoft. And so then he says, okay, the powers that be within my firm agree with you. They agree with your analyst, and we want to buy Microsoft. So now I'm going to place an order. I'd like to buy, he says to me, I'd like to buy 1 million shares of Microsoft. And I say, great, excellent, thank you. And then I go to my trader, and this can happen two ways. Either my trader has to be at risk and he has to give a price. Where would my trader sell 1 million shares of Microsoft? Or you just buy it in the market, right? Everyone knows the equity market's a visible marketplace. We know every share that prints, every trade that happens on the marketplace. And so there's two ways to trade, right? Either you can just use the marketplace and actually just buy. There's people in the system that are selling, and you don't have to necessarily use the risk of the trader. Because there's a physical marketplace for it. Or you can say, no, I think that when I buy 1 million shares, it's going to move the market, and I want to buy it at 1. And if I try and buy 1 million shares right now in the market, it'll affect the price, and I'm going to end up buying it at $1.10. I don't want to. I want to buy it at 1, and that's where I want your trader to sell it to me, and that's where there's risk or not involved. Does that make sense of sorts? So that's the part of there's in cash, what we call cash is just specific, just straight, I want to buy 1 share of Microsoft. That's cash, meaning you give me cash and we'll execute for you. Simple. Programs is part of I want to buy a basket. I want to buy, all of, specifically, international stocks or something, a basket of international stocks that what's your name? Mario? I'm just using you for an example because it's easier. Like, he's not going to say to me, he's not going to say, I need to buy these 100, like, one share of each of these 100 stocks. Like, that's going to be too difficult for me to take an order, so we would fashion that in a program order. So it would be in a basket, and we'd have a way to handle that versus me trying to, like, type in, like, one share, like, as dealing with, like, more of, like, specific one stock. This is, we're buying 1 million shares. Program is, like, a lot of, like, hundreds at a time. It's more efficient. And then risk arbitrage has to do with when there's like a merger and acquisition, and the two companies are going to be they're going to be joined together. They're going to become one. So the price has to merge, and there's different probabilities surrounding this, whether or not the deal is actually going to go through or not, and people play that spread, if you will. And then there's derivatives, right? So that was straight cash. Mario gave me money, I bought the stock, I give him the stock, we take the money, we're all happy, it's done. In derivatives, right, there's different, you can do puts, calls, different strategies, etc. So there's a separate desk for that deals with the options. And then there's electronic trading. You, Mario, decide that you don't really want to talk to me. You would rather just use our systems. You want to use the computer, and you think that you can either, maybe it's small and you're like, I don't want to bother her. It's really, really small. I have a system that goes straight to Nomura, and I can just send an order and it goes straight through, it bypasses me as a salesperson, and it goes straight into our systems, and it executes electronically. And so that's part of like electronic trading. There's all sorts of different ways you can do that and avenues. And that's obviously, I'm sure you guys have heard about this, which is why like the floor of the exchange is becoming, there's a lot less people down there, it's a lot less exciting, and that's because electronic is becoming much more popular and efficient. And then there's proprietary trading, just taking views outside of clients entirely and just trading equity products. Yeah.
That's a good summary.
Is that too much? That was a lot.
No,
Sorry.
that's good.
That's good.
Yeah, it's okay. We started.
So credit is essentially bonds or credit default swaps, which you read a lot about. But again, you have salespeople covering accounts, traders taking positions and making markets. But the various classes of trading within credit are investment grade, which are your high grade issuers, highly rated issuers. You have the high yield market, which is sort of a middle tier. A lot of telephone companies and that sort of thing issue high yield bonds. And then you have distressed, which are sort of the lowest rated companies. And so that's how it's really organized around in the credit space: high yield, distressed, and investment grade. But you also have correlation trading, which you don't really have in a lot of other products, but trading the correlation between high grade and distressed, and high grade and high yield. Credit markets were just at the forefront. I mean, they've been sort of some of the most profitable areas of banks over the last few years, really up until the most recent year. And the market has just been, there's no central clearing place for credit in the same way that there is for equities, so there's no price transparency. So if you're making a price in a credit default swap that's on an illiquid name, you make a price not knowing what side of the market your client wants to be on in general, and you make it given or paid, and then the next trade could be 10% different, on the next price, and it may not trade that day, it may trade the next day. So they are moving to a regulated exchange market for CDS, which will create transparency and create more liquidity. But for the time being, it still remains sort of the wild west of trading. And literally, at Citi, I sit across from the credit guys, and it's nuts. I mean, they're the ones yelling and breaking phones and a bit old school, what you read about when you read your Liar's Poker, that still exists, and that mentality still exists. And credit space today. Munis, market, government raises any institution that's qualified by the IRS to issue tax-exempt bonds. So it could be a government, it could be the University of Richmond, it could be a hospital organization. They issue money in the tax-exempt market, and that's the basic. It's the same thing as credit. You still analyze credit in the same way of the muni, but munis have been coming to the forefront more recently because you start to see Harrisburg getting close to defaulting. You start to see California municipalities having a lot of issue because there are two different types of bonds in munis. You have revenue bonds, which is, as an investor, you participate in the revenue stream of that entity that issues the bonds, or you have a general obligation, which relies on the state of California's ability to raise taxes to meet its obligation. So again, two types of bonds, revenue or general obligation, and you go through the same type of high yield, high grade, short term, and distressed type of bonds for munis. Prime finance is prime brokerage, which you hear about. It's really been an industry built around servicing the hedge fund community. Stock lending. A hedge fund wants to short a stock. They need to locate that stock prior to shorting it. So there's a financing desk that goes out and locates from the institutional fund managers where a hedge fund can borrow that stock in order to short it. And then there's all sorts of other risk management technology. A lot of hedge funds don't want to build the infrastructure around creating their own internal fund. They want to leverage the platform that exists at a Nomura, at a Citi, at a Goldman, Morgan Stanley, and use our back office, use our technology, use our infrastructure or reporting. And so they don't have to invest in it on their own, right? They don't want to pay to set that up. And then capital introduction is essentially people introducing fund managers to capital. And it's a very important part of prime brokerage. So if you're a successful trader at Nomura, at some point you may spin off and want to create your own fund and run your own money. How are you going to raise that money in order to do that? Well, you have a proven track record at Nomura, and so someone from Capital Introductions would marry investors who are looking to get that type of exposure to you and your trading style. Structuring is just a role. It's often found within the sales and trading program. Structuring tends to be the idea. A lot of the idea generation comes from structuring. So, they work with sales and trading to help clients express views, or the structuring team looks at market anomalies and tries to structure products and strategies around those market anomalies. So, it's a really unique area to work in. Equities has it, fixed income has it, FX has it, and you're not necessarily managing external relationship, although you're involved in the sales process, and you're not taking actual risk like a trader. You are involved in the overall process, and you touch a lot of different places. All right, so we've got about 5 minutes before we wrap up, and then before we go on to sort of the interview portion of this, does anyone have any questions on what we've gone over so far? Are you feeling pretty good about the differences between sales and trading and where you might fit into each one?
When you leave here today, and somebody asks you the presentation you went to, can you explain what is sales and trading? That would be probably, if you don't start asking questions.
I guess just looking at this slide with culture, how does culture differ among the different product groups, would you say?
Among the different product
Or
groups.
like they have different personalities.
I think it's like bank specific, but I think credit across the board by nature of the market that it's in, and probably securitized products as well, since whenever there's lack of transparency and lack of liquidity, it tends to attract a different type of personality than a large, liquid, transparent market. So, if you think about how you make a price in a security, that will sort of dictate, and the level of risk involved in that price you make, that might help you think about the type of personalities that might be involved in each of the products. But I think key differentiator is, for you, or for you all collectively is, do you like macroeconomics or do you like micro-specific, credit or equity stories? And then once you differentiate between those, it kind of helps you. Then you can find within each of those products a more quiet group if you like it, or a more loud and rambunctious group if you don't. So you guys have this in your packet. I don't want to spend a lot of time on the slide, but look through this after you leave here today, and think about when you go through the interview process, how you can weave each of these bullet points into questions to ask during an interview, because this is something you can't necessarily know until you work at a firm. But if you ask a question like, what are the key points that your leadership team tries to instill in the culture of your firm, that's sort of an interesting question to get asked. Or, what type of training and mentoring does Nomura have that other banks don't? Or, what is your goal if you're talking to someone in equities, what is your goal in equities? Is it to be a top 5 player? Is it to be a top 3 player? Do you want to be number 1 with international accounts, but that and international accounts are your focus? So take these slides and think about how you can weave them into interview stuff. So the role of an analyst, you basically start out as a general desk backup. You're basically there to help out. That's your job. Your job is to sell to the salespeople, sell to the traders. You're trying to be an integral part of the team. You get promoted to associate. You continue to enrich your knowledge of the markets. You start taking on specific responsibilities. You get promoted to VP or director. You have more of an individual client base or an individual product that you start to trade or sell. And then you sort of move on to leading a team or being the true expert of a product. So, analyst, associate or AVP, VP, director, and managing director at desk head. All right. So, in terms of interview stuff, let's just talk for a couple minutes. In sales and trading, Elizabeth said it earlier, it's just about being hungry. I mean, you have to be willing to run through a brick wall. Whatever someone tells you to do, you go out and do, and you run through that wall better than anyone else would have done it. So whether that's getting a coffee, or putting together a presentation, or helping with a trade idea, you just have to find your own way. And if in sales and trading in particular, you have to be able to think quickly. You have to be able to have a view, express it in a clear and concise way. You have to be able to recognize patterns or recognize your unique perspective of a pattern and be able to spin it in a way that makes sense. So, whether you have experience selling jeans on eBay and buying them from a thrift store and then selling them at a higher price on eBay, and that's how you made money, or you're selling ticket sales and arbitrage. Like the markets are all about arbitrage and figuring out ways to make money. So find something in you that shows your ability to make money, and that's what sales and trading is about. You have the rest of the stuff in your packet, so
yeah, I think, just in terms of, just to wrap it up, in terms of what I guess this more applies to the juniors and seniors, but I guess for internships too, for the younger. I think a question that we get asked a lot is what's important. I have this interview coming up, like what's important, what do I need to know? And I think for me, and every interviewer is going to be different, so this would be my opinion, but I think what's most important is knowing your resume and knowing that that's what you have on that piece of paper is what all anybody has to see about you, right? So you need to know that resume, and you need to be able to explain yourself and to be able to sell yourself to the people sitting in front of you, that the next guy that walks in is going to have the same piece of paper with similar, right? He's still going to be from Richmond. She or he are still going to, whatever. They are on this fund or that, or they did this fraternity or whatever. Everybody has similar characteristics. You need to find the things that are going to differentiate you from the rest, and I think that's really important. Be able to tell your story, and this is something I know they say this all the time, but you should be able to practice it. Why are you better than the next guy that comes in? What do you think makes you special? And like Brant said, like run through a brick wall. Like you have to, like, this is a show me kind of a, this sales and trading is a show me kind of a job. Like, what can you do and how are you going to get it done in the most effective way? And that might be different talking to me versus talking to Brant, and that's part of it. Reading the people as well. Like, what do I want to hear versus what does Brant want to hear? I bet we want to hear different things, to be honest. And you have to kind of read that, and that's going to be the same way if you're sitting in a sales seat with clients. It all applies. It all kind of comes full circle. So when you're in that room, just think about and be confident about what that is on that piece of paper that defines you, and be able to portray it to the people sitting across the table about why it is that you're the number one. And that's as simple. Then you get into whatever, that if they ask you math questions and whatever, I think the best thing about that is to just, you stay calm and you think about, a lot of times it's less about the final answer and it's more about the process, and they're trying to rattle you, and so you say, okay, you know what, take a step back. You take a deep breath and you say, okay, you know, this is, well, I don't know the answer. I don't know how many balls I could fit in the airplane that I just flew down on, but if I had to, like, each one is this size, and you go through the process and just like talk it through versus getting panicked and like freeze and then freak out. Just, I think staying calm is also very, very important.